Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to try to answer questions related to retirement, asset management questions, how to manage taxes in retirement, how to, plan for retirement in general. We answer these questions live if you'd like. You can send them in now. You can do it two ways, either through the chat here on the channel if you're signed in, or through our email address here, asktom@talkmoneywithtom.com, and we'll watch for those as they come in. And obviously you can send an email during the week. We cover questions that come up during our client sessions also that I think are probably useful for others to know. And so anyway, that's what's happening in terms of the overall process of the show. Obviously, if you want to subscribe to the channel, you can do that. Hit the subscribe button. A little bell will tell you when we put out new content. I got a notice the other day that we just hit 2,000 videos on the channel. So there's a lot of content on there that you can go look at if you have other questions that we don't cover today. And of course, if you have questions you want to ask on a personal basis, you can schedule a time with Ethan and I. There's a book appointment button up in the corner of our website, and you kind of go to that and pick 30 minutes to meet with Ethan and I, and we will take care of any questions that you have on a personal basis. So I will, just as an announcement, we're not actually doing the show next Friday. I will try to do a summary for the week because I start off every show with a summary for what I saw happening in the stock market, and we'll probably post that as far as that goes, but no physical show as far as that goes. So I do, of course, as I said, like to start off the show each time with kind of a weekly summary for what we saw happening in the market. We've been looking at this chart, pretty consistently at the beginning of every one of these summaries here, where it goes back to 2018, the end of 2018 to this week. And you can see actually the market's up a lot in that time frame altogether, with lots of interruptions, including the pandemic, the 2022 downturn, Liberation Day, which is right over our heads here and such. If you look closely, you can kind of see that the market is slowing down in terms of its recovery from the Liberation Day tariffs from last April, and been going sideways essentially since the end of October, for all intents and purposes. And just, again, just kind of keeping track of this pattern for the last, 2-3 weeks now. Yeah. This is what's called a flag pattern. So I just kind of zoomed in here. So we're looking at, just the more recent time frame. You can see Liberation Day drop there, and this is now daily data, so we can look at it instead of weekly data. So each point on this line is the end of the day, the close for the day. And this flag patterns are typically in place for a continuation. It's if the market's going up, it should break out to the upside out of this pattern, and then go right. It's pretty interesting that this week we came right down to the bottom of that pattern, and then today we've bounced. Yesterday we were down almost 1.6%, and we'll talk about kind of what's going on as far as that goes. There's some data that came out with the inflation reports and the jobs reports, which I'll get to in a minute. I want to talk about the things I thought were the biggest drivers. And it had to do with artificial intelligence, but in a different way. Artificial intelligence has been driving a lot of these individual stocks down because their earnings reports have big numbers that are being spent for artificial intelligence data center build-outs. And so that has been happening. But what's been happening behind the scenes and now is kind of rolling into different industries is the fear of artificial intelligence replacing or damaging that company's product, earnings, whatever you want to talk about. So it could be anything from software companies, right, that have been hit pretty heavy. That's kind of where it started, because maybe you don't need to have that software if you can create it yourself. As you're a big company, maybe you don't have to pay all that subscription fee. You could go use Claude or whatever's out there and develop your own. And so there's, some fears to that. Or competitors can come along a lot easier, and make inroads. And so we've seen, Microsoft and Salesforce and all of these different pieces. And what really transpired, especially yesterday, was it's rolling into other industries where there's some concerns that AI might, replace. So financial services, trucking, logistics, and all these different things. And so I think it's kind of interesting as far as that goes. It's going to, even if these things are true and they happen to come along and be the case, it's pretty far off from what we can see. And it's going to be quite difficult to take a Microsoft, for example, to replace them as a company. And, Microsoft is not going to just sit on their hands. They're going to be trying to add the different AI pieces to their portfolio. These companies are all in a big race, for example, to build these data centers. They cost so much money, it's going to be very difficult for other people to build them. You're going to have to really have some huge fundraising in order to keep up. You look at, kind of all the pieces. I think it's really kind of overblown. It's not unusual. We've seen, over periods of time, and we talked about this last week, but DeepSeek, which was a, AI algorithm developed in China based on, computing systems that were a lot less expensive to build.
Yes, you just needed less power.
Less power, lower end chips, right? That's what was available to them. And at the time it was seen as a very, revolutionary motion. And of course, NVIDIA stock got hammered. We may be double that where it is now, So that's the same type of thing I kind of see happening here. Is yes, that might be, like DeepSeek might be a big deal longer term, but you kind of oversell it, and these companies are still going, and it really discounts the companies that are being sold off. It discounts their ability to respond to that, and they're pretty good. That's how they got there, and it discounts their ability to buy those people that are making those things, because that's also very common, in the industry is where things are happening. And you look at like trucking logistics. It's an interesting example. So you could replace trucking logistics with your AI, setup. But it also allows those trucking logistics companies to use the same thing and be more efficient, most likely, right? So less labor involved to do the same things. Because it's one thing that they already have the client base. It's not that easy to build up a client base. It takes some time. So we could be starting off on a big change here, and I think that is important, and we'll be watching for that. But altogether, we're looking at a situation where it's going to take enough time that I'd be surprised if the market isn't higher here at some point in time in the short term.
There'll need to be some maturity for any kind of software.
Yeah.
So for the trucking industry, the drop was based off of a company that released a logistics software, an AI company. But you have to also think is, will the AI be good enough? And especially with logistics, there's always going to be some sort of extreme case. Can the AI software adjust to that? And so I think there's a study by one of the big consulting firms, and they found that AI works for very normal situations, but in extreme cases, like an extreme downturn or some sort of weather event, humans still are better than AI. And so I think that's still important for most of these logistics companies.
Yeah, I mean, this is not our area of expertise per se, but we are in Silicon Valley. We do have clients that work for these big companies. They're specifically working on AI, and even some clients that are managing groups of people working on AI. And the thing we keep hearing is that it's just not really there. It can do kind of the lower end things, and it can't do the higher end things. This is basically where it's at. And so there's kind of this fear within the market that these things are going to be able to do everything, which may be true, but it could possibly be far enough off that it's not that relevant today to the stock market, correct? So and again, discounting what these companies can do in that environment in terms of their own productivity.
Yeah, I think it's just a natural overreaction by the market, because the market kind of is fueled by two things: greed and fear.
Yeah.
And once you have like a fear contagion, it can spiral to a lot of companies, even though there's only an off chance that could affect them.
Yeah, this is not unusual. It could be, like I say, a precursor for what could be coming for the long term. But I think there's a couple other things that factor in here. One of which is just look at this pattern, right? So, we've been going sideways since October. So there's not momentum to the upside or even momentum to the downside for that. So it doesn't take much to move things in an environment like this. When the market's moving up strongly, it'll ignore a lot of the things that we might consider negative, whether that's an earnings report or comments during earnings report. It's just the opposite when the market's moving down strongly. You can take a great earnings report and say one little thing, about the future or what have you, and all of a sudden your stock is dropping quite rapidly. So there is that piece here where, it's sort of like a small amount of wind can make a lot of change because there's not a strong motion one way or another. So, and as I said yesterday, the thing, to keep in mind, we had this big drop, it's a red shirt day, but all this is just noise. We're just going sideways, right? And until you fall out of the bottom of that or jump out of the top of that, there isn't that much information to be gathered, out of these particular scenarios. You can see here all of those lows within that flag pattern are actually higher every time. And so that means the dip buyers are coming in sooner and sooner. We're not the only one watching this trend line here, believe me. So, it's pretty amazing that yesterday it got right to the trend line and then turned around and has come up. So, getting back quickly to kind of, the overall concept, and, because right now they've got kind of have this AI destruction that's happening. You have this AI, data center build outs. I have more concerns about that in the short term than I do about the AI destruction, because I do see the possibility for AI destruction, but I see it's far enough off. But the AI data center build-outs, if they slow down, it is the main thing that's driving the whole economy. So it could, and we have enough headwinds with tariffs and other things like that that we're overcoming because of that AI spend. But if we slow down on the AI spend, and there's three things that have come up over the last couple of weeks that are starting to show, some reasons why they might slow down. Number one is investors are starting to rebel against companies that are spending lots of money on AI build out. And whether they should be or not, it's irrelevant. It's going to, when Microsoft drops 10% after they announce how much they're spending on AI, it's going to make Microsoft think about whether they should be slowing down, because investors, went to school, went to a finance degree, and the thing we learned, and it was like, your job as running these companies is to increase shareholder value, period. At the time I went to school, there was nothing about, the ESG type concepts, and it was increase shareholder value. So if you're, if you slow down on some of your AI spend, does that, at least in the short term, looks better, stock might drop. Meta comes to mind because they were spending so much money on the metaverse, right? And they were getting hammered. I remember it dropped like 40% at one point. And then they started, backing off of that, and the stock has done really, really well. So that, but that backing off of spending money on data centers across the board is problematic, right? Yeah. For the economy as a whole. So something we're watching for. We haven't actually seen that yet. It just comes to mind that the pressure is going to be there, and see what happens with that pressure and how they react. And of course, these data centers need these products in order to be built, in order to actually have a potential to create something that would be profitable, which is what everybody's complaining about. And so if you're short something, like right now, memory. So memory's in, high demand with all the different things going on, and it's the supply has not been able to keep up.
Yeah, I think the memory suppliers are just, they're worried about every time they've increased production to meet demand, they've run into a slowdown and kind of they basically have a oversupply, and then they run into issues. And so they've decided this time they're just going to hold steady and slowly increase.
Yeah, which again would slow down the outputs and abilities to build these data centers, which could again be a headwind that we have to watch for. And it's not that easy to ramp up memory, overnight. So it'll take a little while to get that going if they do decide to up their production. And then this week, there was different commentary and hearings that are going on within Congress to work on energy, because what's happening is these data centers are coming in, they're using up a lot of energy, and the utility is raising the price. And of course, these Congress people are hearing from the constituents. So talking about the possibility of restricting the energy that goes to a data center, which again would be, and right now we already know that energy is a bottleneck anyway. Matter of fact, it might be the biggest bottleneck in this AI build out. So if Congress gets involved with regulations, again, hasn't happened, but those are the three things that are kind of out there as headwinds of that, I think, probably the most important component of the economy right now. You take that out, we're in a recession. We have a stock market that isn't doing this. It's probably not going up, as far as that goes. So that's why we watch. None of those things are happening, but there's three. Well, I guess the memory is happening, but nonetheless, there's three things that are kind of sitting there that weren't there, not that long ago. And so that, those are the areas. And then if you look at kind of the headwinds, the things that have been, slowing down the market, like I've been saying for quite a while, this market should be quite a bit higher than it is now. Mm-hmm. It shouldn't be going sideways for 3 months. The reason it's going sideways is because of all these headwinds. This particular administration is ballyhooing all these records that are being set, but the stock market actually isn't doing that great. I mean, we had out of the big international markets last year, we were last, which is not normal. We usually are first. And yeah, it's going a little bit higher. We have set, in here, I think there was 4 or 5 different, all-time highs that we set, but they were just barely there. It only stayed there for a day or two and it fell back down. So, there are headwinds, and that's why the overall tailwinds, the AI and the Fed reducing rates, right, are the main ones that are driving. And I guess earnings have been good, right? We have 15% earnings growth in this earnings session, or this period of reporting. And so obviously the trade issues are a headwind. That's probably better altogether. We have the USMCA to deal with coming up this summer. That'll be very interesting. That's the Canada, U.S.-Mexico trade. A lot of products are still at zero. There's been rumors that they might try to back out of that whole thing and such. So that's to be determined. But like today, they talked about reducing tariffs on steel and aluminum. And so, these are coming from pressure points within the industry, and they've been responding. And we've been seeing net tariff come down and down and down. It's still really high compared to where it was, but it's been lower and lower. So that means that headwind has actually been getting a little bit weaker recently. The other, again, we'll have to watch for what happens this summer, but the other thing that was, I thought, a big headwind for this year would be the Federal Reserve and replacing the Federal Reserve chairman. 4 people are being considered. A couple of them are pretty scary to me. And they chose the one out of those 4 that I think is probably the best one. Has good experience in the Federal Reserve. Had been on the board for 5 years in the past. Has some fairly conservative views on kind of what would be an economic expansionary view, in the sense that we want to do less of the quantitative easing, which could be a problem if we have a big downturn, because that's something we've used in the past. It is sort of like borrowing from Peter to pay Paul in a way, right? So I don't totally disagree with him, but there may be some pressure there. But nonetheless, this Kevin Warsh, because that could have been something really crazy, like Hassett gets chosen. He's talking about trying to lower rates 2%, get it down to 1% rate in this environment. And so, because what we've seen this week is we saw the jobs number come out for January at roughly 130,000 jobs. The expectation was about half of that, about 65,000 jobs. I'm rounding a little here, but nonetheless. And so that was fantastic. However, at the same time, they reported that over the previous 12 months, there was 580 some odd thousand jobs reported, and they've readjusted that down to 180,000 jobs.
Yeah, so it's about 15,000 jobs per month.
Yes, which is anemic, actually. And so the market kind of has been, worried about that, right? Just that, that the job growth hasn't been as great as we think. And the Federal Reserve actually was talking about that, and Chairman Powell's brought that up in some of his question and answers, that he felt that the jobs were being overstated by 40,000 a month. And matter of fact, back at that time, he said, they're stating 60,000. It should be 20. Turns out it was actually 15.
Yeah,
right?
So he's pretty close on that.
So these jobs reports, and this isn't a partisan thing, actually. We had 800,000 jobs reduction for 2024 during the Biden administration, which wasn't, as a percentage, wasn't quite as high, but nonetheless, still
a big number.
A big number, And honestly, now I'm looking at these jobs reports, and who cares? I mean, it's at 130. Well, what's it really going to be? So And actually, you can see the market doesn't respond that much to it, as much as it used to. These revisions are kind of, taking down the power of that report. And then CPI came out, and it was lower than expected in certain areas. So it kind of depends on what you're looking at. But year over year, CPI went to 2.4%. It was 2.7, and so that's big difference actually. Expectation was 2.5. If you take off, food and energy, it was pretty similar actually. And so, but Houston was telling me about there's headline inflation.
There's core.
There's core inflation, which is taking off food and energy, and then there's
super core,
right.
which you take out housing now, and super core for the month over month was around 0.6%, which is quite high.
Yeah. So what they're saying is that from December to January, right, the month over month, because this is a report that's for last month, you had 0.6%. So again, annualize that out. If it happened to keep going for 12 months, just to put it in perspective, that's inflation on that category of 7.6%, which is very high. It also is a category that is probably more related to the tariff, right? Because ultimately tariffs can raise price on everything. Because everything else's prices are going up, then you need to have higher wages, which then can create,
a spiral.
Right, upward. And so that, although that doesn't happen, matter of fact, this particular Federal Reserve Chairman feels that the AI will efficiencies that will be built into there will keep inflation under control, at least partly because of the fact that you've got very low pressure on wages, right? Because it's going to be difficult to, theoretically, if you have excess supply of people, then you don't have to raise wages as quickly.
Yeah,
right?
because there will be more demand for the job postings that you have, so there's going to be competition to force the lower earner to take.
Right. It's going to put the companies in the driver's seat. It goes back and forth.
Yeah.
We saw that during, coming out of the pandemic, the employees were in the driver's seat because
you
there's
got a lot of job hopping.
a lot of job openings and not that many people looking. I think it was 2 to 1 at one point in time, and so, that's really interesting what's happening as far as the CPI report and the labor report that came out this week too. So both of those though are good on the face, right? It had more jobs than expected and lower inflation than expected. We do have to worry, of course, unfortunately, because they fired the head of the Bureau of Labor Statistics last summer because they came out with some poor numbers. Turned out that the numbers were probably pretty real with this last adjustment, but nonetheless, we've talked about this several times. It undermines your,
integrity.
It undermines your feeling of confidence. When they say it's 130,000, everybody's expecting 65. The first thing you have to think about is is it a real number or are they kind of juicing it? When they say inflation is, 2.4 when it was 2.7 last one and everybody's expecting 2.5, is it really 2.4? I know it's probably very difficult to fake it because it's not just the one person that makes these numbers, but it just makes you wonder, and that's unfortunate, right? We shouldn't have to wonder because the way it happened, it literally was fired because of the number. So whoever comes in is going to be thinking, well, if I come up with bad numbers, I won't have a job either, right? So it's you want to have this independence, the independence of the Fed, independence of Bureau of Labor Statistics, so that you can get actual, real numbers. Otherwise, you're going to be accused of being like China, which everybody questions the numbers and the transparency, and it just doesn't really help. The currency issues and you want trust globally. And we've lost trust globally. There's no doubt about that. But you want that trust globally because they're the ones going to be buying our treasury bonds to fund our deficit, right? And they're the ones that are going to be buying our dollars to keep the dollar up because they use it as a reserve currency to hold on to in case, everything goes to heck in a handbasket. The dollar might be the place to be, still might be the place to be. But people have been selling dollars, the dollar's down, right, depending on how you look at it, in a kind of 10-11% range in total. So anyway, that's what happened this week. A little bit of a down week. Again, at this point, to me, that doesn't mean anything. Yesterday's drop, red shirt, didn't mean anything. As long as we're going sideways, I really try to keep a very neutral look at what's going on with the market. When we fall out of the bottom of that, okay, that means something. And when we jump up above the top of that, if we do that, that means something. But in between times, this is just kind of noise. It is fascinating to see the rotation of this AI destruction come through, because that's been happening, I guess, since October. And it's been rotating into other businesses. Mm-hmm. That's not going to stop anytime soon, so that'll continue to go. Probably gives some opportunities to buy in certain areas, I would guess, because almost certainly we're overdoing it. And we're in a period of time where the market's going sideways, so you're not going to have that much momentum to really go anyway. But the dip buyers are still there. Our lows are still higher each time, at least at the moment. So, we'll see how it goes. It's an interesting time. All right. Well, thank you for joining us for the summary. Let's move on to the question and answer section of this show here. What do we have for our first question?
Is the software sell-off a buying opportunity or a warning sign?
Yeah, we got a chart for this. Let me share the screen right above Easton's head there. This is just 12 months, and it's daily data. The green line there is the S&P 500, which is up 12% in the last 12 months. Mm-hmm. And the blue line there is the software ETF. So it's a bunch of software companies: ServiceNow, Salesforce, Palantir, Microsoft, etc. That's down 22%. So, and you can see the divergence happened here around October. Mm-hmm. And this is this AI destruction, right? And this is where the market is starting to become concerned that these software companies are going to be negatively impacted in some form or fashion with what's happening, with AI. And so, is there a chance to start to buy, at this point in time, or should we be selling? I would say, you got to start at the top. The economy is still fairly strong. The consumer spending numbers is okay. The earnings reports were 15%. The stock market is going sideways. The primary direction is still up. Mm-hmm. Okay, so those have to be there. If the primary direction for the stock market is down, and you're trying to bottom fish in, this IGV, you're probably not going to make money because, basically the rising tide or lowering tide floats all boats, right? I mean, So you got to start at the top, in my opinion. So we're in an environment where things are okay, not spectacular, but okay. And so that would mean, okay, that gives me, a green light on the overall scenario. And so I can go down and look at a company like Microsoft, which dropped 10% after its earnings, and say, okay, is that a chance to buy? Yeah, I have no problem with that thought process. The concept of AI destruction, again, it reminds me of previous situations that have happened where people like DeepSeek with NVIDIA, where people were worried about, this replacement that was going to happen, and overselling of that stock happens in such a big way that you could come in and kind of nibble at that. And you got to have a longer term outlook. It could take a while. And unfortunately, they could be right? Mm-hmm. Yeah. The AI thing could drastically, so it's a little bit like kind of catch a falling knife concept, right? So you got to be careful.
Sometimes you catch the blade, other times you catch the handle.
That's right. So, but yeah, I would be a buyer here of some of these pieces. It depends. It's not,
Would you be looking for certain companies, or would you go for an ETF? Like, how would you attack it?
I don't have a problem with this ETF. I do like the diversification and having a 34% differential from the stock market over a 12-month period. In a group of companies, it's pretty strong altogether. I wouldn't have a problem with, bottom fishing at something like IGV here. But also, I'd probably be really looking. The companies that strike me, again, that jump out at me, Salesforce. We use Salesforce. I'll tell you what, they can come up with something better than Salesforce. It's really, really hard to change.
It's a pain to switch over any kind of system. Same with Microsoft.
Same with Microsoft, and all it's embedded with Teams and all the spreadsheets and Word, and we have a huge legacy investment in both of those softwares, and they've got their own thing, Copilot, and they're doing things to try to make that software better. and such too, but it's more of just it's very difficult to replace those. And so that I'd be very interested in that, right? So if Microsoft's down a bunch and Salesforce is down a bunch, those are two pieces that would interest me, just because the installed base is so large, and it is difficult for change. Even for, it would happen over time if something was significantly better than Salesforce and easier and likely cheaper, because it's not a cheap software.
Yeah, and you want to have some conviction. It could be like, hey, I have conviction that Microsoft, because of just their high install base, they have a captive audience that's integrated into their systems, that they will continue to generate revenue. Or it could be like, if you look at the top holdings in IGB, they also is Palantir. You could say, hey, I have fear for Palantir because 60% of the revenue comes from government spending. If there's any kind of cut to their budget, what would happen to that company? So you can start to pick and choose, but it's a good, IGB would give you exposure to everything kind of in that field.
For my philosophy on individual stocks, I look at it and say, do I believe in this company enough that if it drops even more after I buy, that I would still buy more, right? Or not? Am I, so that you have to have a high level of conviction. And so that's how I basically invest. I might have 20 stocks. I have to believe in those stocks. And so when they come down, I try to add to them. And, at some point in time, like I did that with Target for a long time, and eventually I lost my conviction and sold my Target. And, I really felt like they would turn it around. But at the same time, I've done it with lots of other stocks that have worked out really well, Ristonet or whatever it might be. So, yeah, I think that's, again, if you're going to try to buy on the dip, make sure it's with companies. The ETF here is well diversified, so I like that. That helps my conviction. I feel like as a whole, somehow this will work out, and I might see it go down more, but I'd still maybe be willing to dollar cost average into that. Individual stocks like Salesforce or Microsoft coming down, again, I'd have conviction with those until proven otherwise.
Yeah, and you want to keep all these targets to a small percentage of your portfolio. Nothing that would be, nothing that would be life-changing if they were to fail.
Yeah, exactly. Sometimes you get into some of these situations where even small dollar amounts can turn into big numbers. I remember in '95 when Apple was going out of business, or not, or seemed like it. They were getting a loan from Microsoft, and Scully was running it and what have you, and Jobs was just coming back. Small investments like 15,000 have turned into millions of dollars. So, we're not talking about that kind of destruction here with these particular companies. Netflix is one that's seen a huge drop off because of their merger activity that they're trying to do. It could be an opportunity there also. We'll see what happens. But anyway, it's very fascinating to see how this plays out. All right, that's a good question.
So, what are your takeaways from CPI, and how do you feel it's going to affect the stock market in the long run?
All right, so Consumer Price Index, right? That's what CPI stands for. This is a measure that most people would associate with inflation. The Federal Reserve actually looks at PCE, which comes out at the end of the month, which most people don't know about, actually, personal consumption expenditure. And so when the Fed is trying to lower rates, so that's an important distinction, because you have to understand that the Fed isn't really looking at CPI. And so the market keeps responding to it as if, because that's the ultimate piece when you're looking at an inflationary gauge, is what is the Fed going to do? And the reason you're looking at that is because you want to know where interest rates are. Lower interest rates tends to be more stimulative to the stock market, and higher interest rates is less stimulative. So CPI is, in this last report today, is lower than expected. Right, it went from 2.7% in the top line inflation, including everything, year over year, down to this month being 2.4%. Right.
Yeah, and you would have expected the Fed to kind of want to cut interest rates to stimulate job growth, because the jobs have been very anemic.
Yeah.
But it seems like the market's assuming that the Fed is just going to hold rates for at least the short term.
Yeah, well, we're not having an inflationary, according to these numbers, we're not having an inflationary impact. And as we talked about, during the summary, there's different versions of CPI. The top line is everything, and then the core, you take out food and energy, and then, and then we take out the
housing,
and we get super core. And more they're starting to talk about, as Ethan was mentioning to me earlier today, they're starting to look more at the month over month because we missed data that's literally not in there.
Yeah, October is a weird month.
Right. So the 12-month look back has some corrupted data gaps because of the slowdown. They just put zeros down. Remember that?
Yeah.
And so month over month, we've seen kind of 0.2% on headline. So that comes out to 2.4, which is right where we're at. We saw 0.3% on core. All right, so that comes out to 3.6%, which is quite, if annualized, again, if it keeps going, that's kind of high. And then super core, when you take out rent, is actually 0.6. And so the thing about super core is it probably has the most, impact from tariffs.
Yeah.
When you take all those other pieces. And so, of course, 0.6 is quite high, and that's 7.2% on an annualized basis. And so I'd probably be paying more attention to the super core personally. So to me, that's a little bit of a hotter read than people seem to think. And the stock market's not really responded that great to it today either.
Because housing usually is a very lagging for their inflation indicator. Housing's finally kind of relenting after a long period of being very hot, I would say, in CPI readings. So that's nice too, because that means people are not having rents go up as much.
Right. Right. Yeah. I think, again, you look at these things and you see what's happening, and it has all to do with what's going on with the rate cuts. And so if you go out to the market and you look at the bets on rate cuts, the futures market, right? No expected rate cut in, March or April. You get to June, and we finally are at a spot, but it's the same number. So in other words, a month ago, there was a 70% chance of a rate cut. Right now, it's roughly a 70%, I'm rounding, but chance of a rate cut in June. We've seen some difference in changes in those expectations for rate cuts in the more current times, looking at, the March and April meetings, but there's still no expectation for rate cuts as far as that goes. I think we got to a spot where the overall cuts were expected to be roughly 3 for the year. We're back down to 2 for the year. So, the takeaways are for CPI, I want to keep an eye on super core and see what happens going forward and see if that continues to stay hot, because that might be a better reflection. Because we've now had 3 studies that have come out and shows who's paying the tariff. Is it the foreign country or company, or is it an American company or American consumer, right? So all 3. One of them said 96% being paid by Americans. One said 94%, one said 90%. Okay, so 3 different studies saying that almost all of the tariffs are being paid by American companies and or American consumers. And if you dig down even deeper, what you're seeing is that more and more the companies are starting to push that through to the consumer.
Yeah, they're not going to eat the profits.
They've been eating them for a long time, and and we've seen some decrease in tariffs, so maybe that's justified to eat them because then you're not messing with your market base as much. But again, the longer you go, the more these companies can't eat these tariffs, and the more they're going to pass those along. And probably why there's a reason that we're starting to see, just today it was announced, a reduction in aluminum and steel tariff, right? I didn't see the details, so apologize for that, just the headline. But it's something to watch for, too. So anyway, that all relates to the CPI piece here. So I do think it's an interesting arena to look at. Again, the Fed's going to be looking at the PCE report, which will be more important, which comes up at the end of the month.
So what are the changes to catch-up contributions in 2026?
Okay, so things have changed, right? So one of the catch-up contributions are for, in this case, 401ks.
Yeah,
right. And so, once you're over 50 years old, you can put more than the standard amount into your 401k.
Correct.
And it goes up to $8,000 that you can put in.
Yeah, it's $8,000 for standard, and then you have 11,000. What is it?
250, 11,250. What they call that, the super catch-up.
Yeah, from 60 to 63.
And it's really weird. It's from 60 years old to 63. You can put an additional 11,250. Okay, so but the big change is before you could put that into your regular 401k, your tax deferred 401k, and now they are forcing you to place the excess, the 8,000 up to 8,000 or up to 11,250 depending on your age. You're having to place that into the Roth component of a 401k.
Yeah, essentially, if you are considered a high earner, which is 145,000 of FICA wages, so
Good point.
when it's your W2, when you look at your W2, it's that Social Security box wages, which is box 3.
Yeah, so if you're under that, you can still put your catch-up contributions into your wherever you want to. Actually, you can put them into the tax deferred. If you're over that 145, then you have to start putting this money into the Roth. Now, the reason they're doing that isn't because they think a Roth IRA is great for the long term, although it very well might be, because they actually lose money on that. They're not going to make any more money on the growth of that dollar. But it does create a situation where there's a forced taxation event, because when you put that $8,000, let's say, into that Roth 401k, you're going to have to pay taxes on it as it goes in. And so that's an additional dollars out of your pocket. And of course, they're trying to offset some of these other areas and cuts and what have you by increasing revenue.
Yeah, their mindset is that when you take out of your 401k, they have a expectation that you'll be on a lower tax bracket.
Right.
So the idea is, if you're in these high earning years, they want to tax you at your highest tax rate
Right.
to get the
Right.
most taxes out of you at that
Right.
point.
Yeah.
So that's why they're kind of doing this switch. And I think you have to look at your company and see if they offer. A lot of big companies will offer it. Some smaller companies may forego it by just not disallowing catch-up contributions to do that. But it'll be interesting to see how it changes the landscape.
Yeah, if your company doesn't offer a Roth 401k, you can't do catch-up. And so, we've only seen that in smaller plans. The Roth 401k is definitely more popular.
I think most custodians or
Right.
plan operators will have it, and you just have to
Right.
ask them to make
Yeah.
the changes.
So I think, we'll see some of that, more adoption of that if that
Yeah.
does happen as far as that goes. So, I don't think it's a good thing, right? I mean, it just takes away a choice.
Yeah.
I don't think a Roth, is bad, especially a combination. I kind of like it. You put your regular contribution into a deferred account, you put your, excess amount into a Roth. But really what you want to be able to do is have full flexibility, because you always had the Roth anyway. You could always choose how much percentage you wanted to go to
Yeah.
Roth versus traditional tax deferred. And so you could customize it around your income, your tax returns, and your outlook for future cash flow in retirement and all of these things, and figure out, okay, where I am right now, what's the best thing for me to do? Possibly the conversion pieces for converting from traditional to Roth is still out there when you get to retirement. And so basically they're making one of your choices mandatory, which isn't better.
Yeah.
But it is what it is.
And one thing to also note, it doesn't include your partner.
Right.
If you file jointly, it doesn't matter. It only looks at your individual W-2s.
That's right. That's a
And
good point.
so you could have your partner could only earn 75,000, and you only earn 160,000, and together you'd be under. Each would be, if you average the two, you'd be under that 145. But it only looks at what your individual one is.
So your spouse at 75 could still do full contributions into a traditional 401k if they wanted, but you would have limitations on your catch-up provisions.
Yeah, so if you're trying to aggressively save, maybe you switch who saves what.
Yep.
Is if you're trying to kind of control it a little bit better.
Right. It gives you back some of that control that we already had before this change,
Yeah.
but not all of it. Yeah, no, it's a good question. It's really interesting to see. There's going to be, we're heading into tax season now, and there's going to be a lot of new things. They made a lot of changes to the tax code, and so lots of questions are coming up around, how that works and what
Yeah.
we should be doing going forward. If you're over 65, you get this $6,000 deduction. If you qualify, the income levels there, and so there's a lot of changes, and so it'll be interesting to go through them. I think, I think overall people are going to be fairly pleased across the board with the tax return filing season this year.
Yeah.
I think, with the SALT, the state and local income tax deduction was capped at 10,000. Now it's capped at 40,000. Again, that gets phased out over certain income levels, but there'd be a lot of people that get a nice bigger deduction for
Yeah,
those things.
it's a pretty. I think it's the phase out starts at 500,000, so
Right.
you have a pretty big window.
That's right, and there's a big chunk of people that'll be pretty happy with that as far as that goes. Okay, well, that's our show for today. And again, we won't be here next Friday. I will try to do a quick summary of what I saw happening for the week. There's a lot going on. Next week will be a shortened week, right, with the
Yeah,
holiday on
Monday will be
Monday. And so, I'll try to get some of the videos out during the week also for what we saw happening that day. But look forward to being able to see you again in a couple weeks, and we'll do the show again. And thank you for participating today.